Okay, so this past week, the Fed decided to keep interest rates unchanged and issued what has been referred to in the market, and I've referred to as a hawkish pause. The reason I say hawkish pause is because more than half of the Fed members said that they expect further rate increases either later this summer or later this year, but for the time being, they're going to stand pat. Several of the members said they thought that there would be as many as 3 increases, and there were even some members that said that they expected potentially 4 more increases for a total of 1%. So this has been referred to as a hawkish pause. Even though they paused, it was hawkish because many of the members, the majority of the members, expressed continued concern about rising inflation. If you look at the market since the beginning of the year, you've seen rising speculation that the Federal Reserve will not only stop raising, but will begin to reduce interest rates. This has led to increasing speculation in the markets. It's increased prices across the board. The broader market is up about 15-16%. The NASDAQ is up over 30%, and it's led to kind of a bubble in the market due to multiple expansion. So it's not that earnings are increasing. In most cases, earnings are staying about the same or even declining in some cases, but there has been multiple expansion, which means that investors are paying more for the same amount of earnings. This, to me, indicates a period of increasing speculation. The other line of reasoning that goes along with this market sentiment is that in terms of the coming recession, which has been one of the most advertised recession in the history of the universe, people are generally thinking in the market that a recession, if it comes, will be mild or non-existent, also known as either no landing or a soft landing. Now, when you look at the degree to which the Fed has increased interest rates over 500 basis points in about a year, if you look historically, as I have on this channel, and quoting Stanley Druckenmiller, if you go back 500 years, not 20 years, not 30 years, but 500 years, if you go back 500 years and you look at every period in the financial markets where rates have increased that dramatically in such a short period of time, it has almost always, with a few minor exceptions, resulted in a severe recession. Let's face it, even though it's never said by the Fed or said by anybody, the Fed's real goal in its war against inflation is to, number one, crush the economy, and number two, increase the unemployment rate from where it is now at 3.7% to as high as 5 or 6% in order to bring down wage inflation and the tightness in the employment market, and also bring down consumer spending and create economic softness so that these forces that keep pushing up inflation come down and come down permanently. So if the Fed accomplishes its goal, we have to have a recession, and most likely a severe recession, or else the Fed is not going to accomplish its goal of getting inflation down to 2%. Now, I think the problem that many people have that look at this issue is they're just looking at the headline number, the CPI number, and yes, the CPI number is coming down. It's currently 4%. It was as high as 9.1. Yes, it's coming down. But if you look at core, and if you look at the components underlying core inflation, and you look at pressure on wages, and you look at unemployment, and you look at travel, leisure, and other components that make up the core number, you will see that inflation is not only hanging in there, but in some categories still going up. So this is why the Fed came out with their hawkish pause. Yeah, they're pausing, but at the same time they're saying they're going to continue to raise. So my view on that is, why not just raise? Just raise now. Instead of pausing and saying you're going to have 2 25 basis point rate increases later in the summer, just raise now. Raise 50 basis points. Crush that motherfucker. and just get it over with. All right. I do not understand the mentality of these people. Actually, I do. They don't want to crush the economy and be blamed for crushing the economy and breaking the banking system further. I get it, but you're just prolonging the pain. You're prolonging the suffering that all consumers are going through, and particularly the poor. So my feeling on all this is still, I think the Fed has a long way to go. Again, if you focus on the underlying components of the core CPI, some areas are not only hanging in there in terms of inflation, but they're actually going up. And so the Fed is a long way from the 2% target, and there's going to be a lot more pain ahead, not only for the financial markets, but also for the banking system. Whether you're looking at the banks pulling back from lending or you're looking at their exposure to commercial real estate, more things are going to break in the economy, more things are going to break in the banking system. And I think that as time goes on, we can't predict the exact timing of this, but I think we're going to be entering into a period of economic turbulence, and I think that's going to start affecting corporate profits rather profoundly, and I think you're going to have another sell-off and another rebound of the bear market. Well, that's what I have to say today. I hope you got some value out of this. If you did, please subscribe and like. I'd love to have you on board for future videos. And in the meantime, please take a look at this video, which I will put up here, which has some more information about this topic that I'm sure you'll find of interest. So thanks for watching, and I'll see you on the next video.